Thank you, David. Everybody can hear me okay? Thank you, David. Or should I call you Davo? Good morning, ladies and gentlemen.
Good morning.
Good morning.
I am very, very excited. No, I am enthusiastic to be able to participate, have the opportunity to participate in IBIS 2013. But I, along with my friends and colleagues for this last session, have a tough act to follow. We've been through a day and a half of very good speakers and great topics. So we do have a tough act to follow, gentlemen. Nonetheless, we do look forward to both sharing with all of you, as well as having you share with us, because collaboration to drive the continued innovation of insurer-repair relationships will benefit all of us. So to kick it off, let me show and tell you a little about Boyd. Hopefully that gives you a bit of a visual perspective of who we are. And I'm sure much of that looked very familiar to all of you who have been involved in the collision repair industry. We are headquartered in Winnipeg, Manitoba, Canada, where we started 23 years ago with a single location. And as you saw from the video, we are collision repair operators. We operate multi-site collision repair facilities. And like most multi-site, or like most collision repair facilities, collision repair and related services is all that we do. We have, although we are headquartered in Canada, approximately 85% of our locations and 85% of our sales are located in the United States. We currently operate in 14 U.S. states and in 4 Western Canadian provinces. And our annualized sales are now approaching $550 million and are being generated from over 3,300 team members or employees. A unique characteristic of Boyd is that we are the only publicly traded collision repair company in North America. We currently trade on Canada's largest stock exchange, the TSX, under the symbol BYD.UN. And if I were guessing, I would guess that we probably have at least a few shareholders or owners of our company in the audience today. So David, please make me look good. Our strategy can be summarized into 2 key components: operational excellence and growth. Our operational excellence strategy starts with our mission, which we condense into a simple goal to wow every customer and be the best. We strive to have every one of our team members, every one of our employees, have this goal top of mind and top of priority every single day. Our operational excellence strategy also translates into industry best performance in the areas of cycle time, customer satisfaction, and average cost of repair. Our growth strategy has 3 components. Firstly, we strive to achieve same-store sales growth in all of our existing locations. Secondly, we are targeting to grow by 6 to 10% per year through single-store growth in existing or adjacent markets. And for this year, that will translate into approximately 13 to 22 new locations. Thirdly, we are also on the lookout for opportunities for accelerated growth through the acquisition of other multi-location collision repair businesses. And since 2010, we have acquired 6 other multi-location businesses, representing a total of 105 locations. We believe that we are very good at integrating or merging acquired businesses with our company to create not only a larger company, but a stronger company overall. And one of the ways that we do this is that we look to retain strong senior leadership in conjunction with an acquisition. And some recent examples of this would include Larry Jaskowiak, who was the Chief Operating Officer of Cars Collision, 28 locations when we acquired it in 2011. Another example, Steve Laszlo was the Chief Operating Officer of Master Collision, 8 locations in Florida when we acquired it in early 2012. And Rex Dunn, the CEO of Trudeform Collision, when we acquired it in 2010, and Trudeform at that time had 37 locations. So contrary to popular belief that owners and senior managers always leave a business after an acquisition, these gentlemen have retained key leadership positions within our company since the acquisition, and they continue in those key roles today. We have a single brand in the United States. All of our U.S. locations are branded as Gerber Collision and Glass. We also have a single brand in Canada, where all of our locations are branded as Boyd Auto Body and Glass. This gives us an opportunity to leverage our growing scale into effective consumer-based marketing and advertising. It also gives us the opportunity to expend the necessary resources to invest in strategic digital and social media marketing. Our value proposition to our stakeholders includes 4 key components. Firstly, and Tony Aquila spoke of this, we are a strong, profitable company with a strong and conservatively leveraged balance sheet. Why is that important? That is important because it provides comfort, security, and opportunity for all stakeholders. Secondly, we are dedicated to our mission and our goal to wow every customer and be the best. We invest in operational excellence through training, resources, and central services. And this investment in operational excellence also gives us the opportunity to develop strategic relationships with both suppliers and our insurance company clients. We also have demonstrated a successful growth track record and an ability to integrate even large acquisitions, such as Trudeform Collision, which had 37 locations, and Cars Collision, which had 28 locations. And finally, we have a strong culture, a culture that includes respect and appreciation for our people, integrity, and a laser focus on the customer. What do we see for our future? We see continued growth, we see $1 billion in sales, and we see a continuing leadership position in the North American collision repair industry. Thank you for giving me the opportunity to tell you a little about Boyd, and I now look forward to participating in David's panel discussion. Thank you.
Right, thank you very much, Boyd. Can I please welcome to the stage, please welcome Aidan Quinn and Vincent Romans. Right, welcome, guys. Particular welcome to Vincent, who stepped in at short notice in the sad circumstances of Matt. So, particular thank you to you, Vincent. Just a quick overview. Vincent, you actually do a lot of work in doing reports on MSOs, don't you? You have some research documents, so you're very versed in MSOs.
Yes, David. I've been tracking them for a number of years, the trends, and write a number of reports about them and work with the MSOs in discussing their future plans.
Right. Aidan, you worked on the insurance side, and you've had a lot of experience in working with MSOs.
A fair amount working with MSOs, yes.
Okay, good. Right. What we're going to do, I just want to take you through some slides. Matt Ornstein actually did a presentation at an insurance conference in Florida just 10 days before he died, and I've picked out some elements of that I thought we could use as a backdrop. We use sort of networks, consolidation, MSOs. They mean the same thing, don't they, effectively? Consolidation was the first term, it seemed to me, that was used in the North American market for body shops coming together. Is that fair, Vince?
Yes.
Okay. It started, 15, 12 years ago? We say here first wave, but it's almost like the car left the starting grid and got into first gear. So we're in first gear in that. And we've got some issues here, which I'd just like to comment on. But the second line down says, not a roll-up. Could you tell the audience what a roll-up is?
Sure. So a roll-up is simply a model where investors, commonly private equity investors, decide to acquire and merge smaller companies in the same market. They do this because they're looking for cost efficiencies through economies of scale that come from the merged and acquired companies. Another element of it is that this merged company, as it grows and develops additional scale, has a chance to increase their valuation multiples for when and if they decide to sell the business. And another element is that roll-ups tend to help rationalize the competitive landscape within a market, especially where there's overcapacity and fragmentation. And this then lends itself to moving out those smaller companies to allow the few who will succeed in that market. So that's the simple model of what a roll-up is.
Does that imply that the North American market will be almost all MSOs?
No. Well, the North American market has X number of MSOs, and it is still a highly fragmented market.
Okay. Brock, do you have any observation on the first gear stage of consolidation on the items here on this slide?
I guess my observation would be, and it's sort of picking up on the discussion of roll-up, whether or not this is a traditional roll-up. Roll-up to me implies the aggregation of a bunch of like businesses to create efficiency, particularly on the cost side. Typically, roll-ups historically have been performed in industries that are fairly simple industries. Our industry is not a simple industry. And the success of any consolidation effort within our industry is really dependent upon being able to execute operationally. And it's been more challenging even in the collision repair environment because operational performance or operational execution has had the bar continuing to be raised. We operate in a performance-based environment. When we acquire businesses, we're not expected to maintain their level of performance operationally. And by operational performance, I mean those key metrics for our customers and our insurance clients being cycle time, customer satisfaction, and average cost to repair. It's very easy to acquire businesses. It's not so easy to operate them efficiently and effectively for our customers.
So are you saying that the experience that you've gained over the years makes you more selective about which ones to acquire?
I think that it makes companies that are doing what our company is doing need to ensure that they are prepared to aggregate businesses with the processes and the systems and the discipline to be able to operate them effectively.
So evaluation of the business before you acquire is absolutely vital.
And an evaluation of your capacity or your ability to operate it after you buy it.
So just buying for the sake of it doesn't work.
That doesn't work.
Right. Aidan, have you got any comments on this slide?
I absolutely agree with what both Vincent and Brock said. I think from an insurance standpoint, I'm trusting that an MSO is doing their due diligence on rolling up the proper elements of acquisition shops to make sure that they're providing a consistent, consistent delivered product to me as the insurer, as essentially the buyer.
Right. Vincent, could you just help the audience understand in terms of timing here? First gear or first wave, how long ago was that when that started?
So it's not a perfect definition, but approximately in the late 90s to the early 2000s would have been considered the first wave of consolidation. Having said that, there were companies like Brock's company and Caliber who had started, and they were moving forward with acquisitions. The second wave started around 2010, and that was a function of a number of things, especially the macro environment after 2008 when the U.S. had a recession, and it impacted the financial markets as well as all other markets in the United States. And that forced what I define as a contracting, consolidating, and converging marketplace, not only for the collision repair industry, but for all segments. And based on that phase, the need for integration became even more important, to build on what Brock said, and or what I call constructive transformation. As Brock said, it's not easy taking these complex businesses over, and the true winners will be those that are able to constructively transform these acquisitions into a sustainable, consistent model that appeals to not only the insurance industry, but to the direct consumer.
I think for many people in the room, the whole aspect of buying an MSO with 37 sites, which is bigger than most networks in most countries, is mind-boggling. The scale here is huge, and therefore your challenges are that much bigger. Let's just
and opportunities are that much.
Yeah, okay, that's the positive spin. Yeah, you ever been a politician, Brock?
No.
Let's have a look at the sort of situation we got pretty much up to end of last year. Perhaps, Vincent, because you've done a lot of work in research, perhaps you could just give us the highlights of what this slide is telling us.
Sure. So this was the preliminary results, not all of it, some of the percentages are. We're finishing up the 2012 research and work on what happened in the collision repair market. And basically, there are about 65 MSOs in the United States that do $20 million or more. And they can go from $20 million up to Brock's company size, as well as Caliber and other large MSOs. We also have a segment called the multiple location networks. And within that group, we have 2 or 3 different models. We have the pure franchise. We have the franchise model that positions itself competitively and believes it competes with the independent and dealership MSOs. So it's a franchise MSO.
So for the audience, can you just highlight the difference between the first pure franchise and that second franchise? What would we see that would show us the differences?
Wow, that's a long. I can answer that with a lot of elements. But The pure franchise, I'll give the example of Mako, a paint and production organization that can do some DRP work.
DRP is direct repair programs.
Direct repair work. So they segment their business internally, direct repair franchisees that are ready, able, and capable of doing DRP business, while the rest of the franchise locations tend to gear themselves to more production and paint, and they don't compete with the larger MSOs. You then have a large MSO like CarStar in the United States, and it positions itself to compete with the large independent and dealership MSOs through all the elements of multiple location networks, consistent process and standards, and the ability to be ready, able, and capable to adhere to the insurance company's DRP requirements. Then you have an organization like Fix Auto, we heard from Paul Gange, which is a combination of a franchise organization and a banner organization, and that they are DRP ready, able, and capable, and they position themselves that way. And the final company that falls under the multiple location network segment would be a company like Abra Auto Body and Glass, one of the largest independent MSOs that also have about 50 franchise organizations that they also market and sell to the insurance industry as one capability as part of their model. So that's the answer to that.
Okay, thanks very much for that. Sorry.
I'm sorry.
No, go on.
And the other segment that's included in the slide information that I see up here is the $10 to $20 million MLOs. And they're the emerging MLOs, but they're also the potential acquisition candidates for the larger MLOs. And if you add the top $20 million MSOs, the MLN segment within the United States for 2012, and the $10 to $20 million segment, that represents about 24% of the U.S. Revenue that's processed of about a $30 billion market. And that's been moving up since about 2006 when we started to look at this.
Do you know, can you give us a figure what that might have been in 2006 when you started recording it?
For example, for the $20 million segment, it was about 9% in 2006. For 2012, it's 15%. So that's the kind of growth it's been.
I was quoted a figure 2 years ago at NACE that within 7 years, so that would have been 2018, that the top 4 MSOs would represent 40% of the total industry revenue. Is that realistic?
You know, the top 4% of the MSOs today in the United States probably are coming close to $2 billion. $2 billion of $30 billion would be the percentage that they represent today. In 4 years?
5 years.
Say 6 years? It's possible. It depends on how aggressive their acquisitions are.
Right, okay. Aidan, this slide is basically saying that the trends in the marketplace, the desire of the customer or the consumer and the insurer means that MSOs are going to be in a stronger position. True or false?
True.
Why? From your viewpoint?
From my viewpoint, MSOs deliver a very different experience to a large-scale purchaser. They, by virtue of their consolidation, their consistency, their business model supports ease of doing business. It provides an insurance company sort of single-stop shopping. It allows for economies of scale, both coming and going. An MSO provides sustainability, consistency as far as product, serving the customer, managing costs, providing a reliable, compliant, and consistent delivery.
Can I just hold you there a minute? I will come back to you. Brock, the whole issue of consistency.
I knew you were going to do this.
The whole issue of consistency. I could understand that, you know, you've got processes in place, you've got plans in place to achieve consistency, but don't you suffer, you know, with the size of your business, also with variability, and therefore you can't always achieve consistency because you're in a human business? How do you live up to his expectation that you're going to get the consistency?
There's no question. Consistency or minimizing volatility is an ongoing challenge that we work at every single day. We believe that there are really 4 key success factors to achieving a level of consistency which can service our customers. The first and foremost is having the right culture. And you'll all recall from the opening presentation, Paul spoke of the importance of culture. Ensuring that every one of your team members knows and understands the goals of your company and what is going to make you successful. And for a company like ours and other MSOs, that culture likely includes an understanding that we operate in a performance-based environment. So expectations are clear for everyone involved. Secondly, you need strong leadership. And in particular, you need strong field leadership. And I'm not talking about field as in store manager. You need strong multi-location management. Some of the individuals that I cited in my presentation, for example, would be strong field management to ensure that what you to inspect what you expect to ensure that you're achieving your desired outcomes. Thirdly, you need a robust technology platform and robust communication system within your organization, because you need to measure those things that are going to result in consistency, and then you need to proactively manage them. And then finally, it's sort of what I call the catch-all, and that is enablers. You need to have training. You need to have central services, which takes away some of the opportunity for inconsistency or volatility. So those would be how we and others, Caliber, we should acknowledge Caliber. Steve Grimshaw, we have Steve and Mark Sanders here from Caliber. Caliber is another very large multi-site operator in the U.S. We joke back and forth. We may have more locations. We joke back and forth as to who has the highest revenue. So we enjoy being friendly competitors. We learn a lot from each other. As I shared some philosophies at the MSO Symposium, I'm cheering Caliber on. And
because it validates your offer.
It validates our model. And I really encourage all of us MSOs to work together to ensure that we do create a value proposition that can withstand the test of time and continue to deliver value to both insurance clients and vehicle owners.
Okay, I'm going to come back to a couple of the points there, but it's just something you just said there about enablers, right? Now, technology is an enabler. Can we have a microphone, please? Sean Carey, where are you, Sean? Oh, you're here, right. Can we have a microphone, please, quickly? Now, Sean is, you won't have any problem with his accent because he's English. Well, you know. But he's been living in the States for a number of years and does a lot of work with a lot of different organisations. And the reason why I want to get Sean involved, I know that he's involved quite a lot in technology. I want to just, you know, you heard here about enablers. Now, technology is an enabler, isn't it? Right. In the terms of the relationship between the MSO and the insurer, how do you see technology enabling that relationship? And also, picking up on Brock's point, the consistency.
I think, is this on? Hold on.
Why are we having... sorry about this, Sean.
Hold on.
Hang on.
Oh, I don't want to stand that close to you. Go on. Let's bring another mic. You're not really going to have me talk into your face like this. I'm not doing it. Again, I think consistency is the key, and Brock's hit on it. And the acceleration, in my opinion, of the MSOs over the past couple of years has been technology-driven. The ability for them internally to communicate using technology, externally to communicate using technology with their insurance trading partners, whoever it happens to be. It's now so simple. You're not reliant on one system, one management system, one estimating system. Integration across platforms is now the norm. The ability to share information, to measure so that you can act and feed that information down to store level, regional level, take actions immediately as a result of it, dynamic in real time, scorecards, CSI, length of rental. All of these things are now, a press of a button away, and not even that. They're there as you open up your management system. Doesn't matter what you operate in. It can be a closed management system, it can be a cloud management system. When it's open, it's there, it's available to you. And centralized management, store management, regional management, they can all see your performance at a glance. And they're now sharing that with their insurance partners and working together, collaborating, cooperating to achieve the end goal, which is, better, faster, cheaper repairs, more satisfied
And
customers.
in your experience, having this data as a result of this technology, what impact is it having on the consistency and also the profitability?
I haven't seen it change the profitability models because it doesn't truly impact the cost or sale price of the product. So the profitability is at the margin level is unchanged. What it enables is the MSOs would, I think, openly say they thrive on volume. They need to fill their boxes full of vehicles, and what technology does is enables vehicles to speed through the system quicker.
Okay, so it's more likely to drive consistency and CSI?
Absolutely, yeah, 100%.
Okay. Right, thanks very much, Sean.
You're welcome.
Agree with that? Aidan?
Yes, I do.
So what impact has it had on your business, having access to this data?
One of the benefits of working with MSOs, obviously, is that they are taking care of consolidating their own data, their own ability to roll up the information in a manner where we can look at it simply and easily without having to create our own technology to grab information from many, many, many different shops. So we can look at one source of data, one source of information that provides us with a fairly reliable and manageable chunk of information, which we can then use to manage how we see the business.
Okay. Brock, it just strikes me, it's actually mentioned about geographic concentration system process integration. North America, you span 2 countries. It's a huge area, but it's fair to say that there is no national chain as it stands today, is there?
I think that would be accurate, Gus.
When do you think that's going to happen, that there would be somebody who would be able to cover every single state?
You threw me a curveball. That wasn't the question that we had agreed on.
No, first of all, we didn't agree a question. We didn't agree a question. It just struck me that from the audience point of view,
sure,
they'll be thinking...
I'm having fun with you, David.
Well, that's nice. Yes, thank you. Why not? Everybody else does. But no, it just seems to me that, in other countries, if I go to Holland or I go into the UK, you have networks which you could generally say are national. Now, I accept they're tiny countries compared to you. But what it means is that an insurer can talk to an MSO and they can have a solution for the country. What do you think the prognosis is for the North America?
Well, let me separate the 2 markets. The two markets that we operate in within North America. In the Canadian market, I would say that today we do have national networks. They are not a corporate-owned model. They are a franchised model, and we have representation from all 3 of them here today, CarStar, Fix Auto, and CSN. So in Canada, I would say that we do have national networks today. In the U.S., we're not there yet. Do I think we will get there? absolutely, at least in the populous states. Now, there may be parts of the country where there may be some gaps, but in the populous states, I believe that we will get there. When will we get there? I believe we will get there within the next 5 years.
Seems if you had a dot for every MSO across the American market, it's very much oriented towards the middle and the west, isn't it?
Yes.
Compared to the east. Is that just coincidence? It just happens to be that the most acquisitive MSOs were based in those areas?
I think in part it's also dependent upon the regulatory environment and other elements of the local marketplaces. And I think, not surprising, the growth has come in the markets where either or both of the regulatory environment and the competitive environment have made it easier to grow. So some of the states that have not yet developed a strong MSO presence, it just may mean that it's not as friendly towards that type of growth and expansion.
Right. We talked about the IT side as well. Branding is very clear here. How important to an insurer is branding of a body shop in terms of consumer confidence?
Well, similar to what happens with, say, the kite mark in the UK, consumer perception is an automatic byproduct that favors what we're looking to do. If we're going to rely on an MSO, to have that be a household name or a familiar name, when you look at Gerber in some states or Caliber in other states, customers know. So if there's a suggestion, not that there's steering in most cases, if there's a suggestion that, well, we have shops that are these particular ones in this area and you can pick, and there's a shop that they recognize as a well-branded, well-respected, they've seen the advertising, there's less resistance. The customer is going to accept that far more easily.
Okay.
David, if I can just add to that. In the United States, and I think the people here from the U.S. know this, but for the rest of you, the advertising spend by the insurance industry now exceeds $5 billion a year. It's more spend than the beer industry has. So branding becomes very important in their need to retain and gain additional customers. And as Aidan said, if a MSO has great brand in a marketplace, even though they're in multiple multiple regions, not necessarily national, that will help them convert these consumers to DRP shops rather than have them move onward to another one where the consistent service that is expected from the MSOs may not be there, and it might be tougher to accommodate the consumer and the insurance company's needs.
Right, but what you're saying is there's more money being spent in the collision repair industry than the beer industry?
Well, the property and casualty insurance
right.
industry
okay.
than the beer industry in the United
wow.
States.
Okay. Well, this probably then justifies this slide. One of the fascinations I had at the MSO conference last year was a session that all they had on the panel were 4 people from 4 different private equity companies. And it's fair to say that one of those companies was a company called Carlyle. Carlyle have since then, I think at that time they purchased Service King, which is one of the large MSOs in America, and they've also bought DPC, or DuPont Performance Coatings, so they've moved into the paint side. So I'm hearing these 4 guys telling us that we have money to invest in the collision repair industry because we think it's a good business model. Yeah? Vince, I'm fascinated by this. Why is this the case? Because this is, people say the body shop business or the collision repair industry is dead. There's no money to be made in it. And here we have financial houses saying, we want to invest. What's happening?
Okay, well, again, it's a complex answer, but starting with the macro level, after the recession, the whole U.S. economy, including the financial markets, were in turmoil. what happened, the financial markets couldn't sustain the type of, and didn't find investments where they could sustain the 20% compounded annual growth that they expected, the 20 to 25%. So their dry powder or their capital reserves were growing. Meanwhile, there's contraction, consolidation, and convergence going on in the collision repair industry, and the private equity industry is looking for alternative investments. They've decided that the 20% to 25% compounded growth may not be what we always need to have now. You've got a fragmented overcapacity market. You have MSOs looking to expand, and they see with this ability to expand, grow same-store sales, have some accelerated growth through acquisitions, the opportunity for additional cash flow, revenue stream, and somewhat good return on capital invested relative to whatever else was going on in the market at that time. So that's just part of the structure that says, hey, we have the ability to ride the MSO consolidation while these other smaller MSOs and one-off shops are taken out for the reasons I just said.
Does this change the way we have to do business in the future? Because the people who are funding it are very different animals from the traditional shop owner and the way that we did business. Does this mean that the business model of running a body shop in North America is going to change as a result of private equity money?
I think it has been changing, and Brock can talk about his company, but what I see is those successful MSOs today have focused on areas that they've never that weren't focused on as much over the last 10 to 20 years, and that's leadership, the ability to have a leadership group that are all working towards the same direction. What Brock talked about, the focus on operational excellence, the ability to accommodate not only the insurance company's KPIs, but their own KPIs, and the bar is higher and higher. Will private equity drive them in a certain way? I think they're already going that way, and that's what part of what private equity likes to see. I was in a meeting with a CEO, the executive team of an MSO, and some private equity people recently, and the term double cool whammy came up.
Sorry?
Double cool whammy.
Right.
And it was a term applied to the collision repair industry and MSO specifically. And what it means is the private equity industry, at least the few that were in this room, saw a double cool whammy in that if they can get same-store sales growth and fill the capacity of those stores at the same time, aggressive acquisition revenue through the acquisitions that the MSOs are making in a slowing down to deteriorating market, to them, that's a double cool whammy.
Wow. So basically, it's make more of what you've got and go and find some more.
Yeah.
Right.
And take advantage of the revenue, cash flow, and return on capital.
Okay, so financial management, Brock mentioned it earlier, what Tony said yesterday, that's absolutely key. And the type of people that are running these big MSOs are in tune with that. Is that fair?
Yeah.
Okay. So what is your message, Aidan, for making a relationship work between an MSO and an insurer like yourself?
Well, I think that one of the key things for us is, again, the consistency, the ease of doing business. Insurers have to do more with less, like all of us. Our promise to our customers is to get them back whole, indemnify them as quickly as possible. So cycle time is a key. So an MSO that is managing its business and deriving the best possible practices and the best possible results, both financially and speed-wise, is going to deliver that to the customer, which is the same as our customer, which eventually becomes us. So having a partner that is delivering on that promise is valuable to us from a speed and an efficiency standpoint. We will not easily be able to depart from the fact that, as Vincent pointed out, the North American market is fragmented. It's a big country, and there is not sufficient penetration and saturation of MSOs. So we're always treading the line between the two. Logically, the more business that we can pull through the MSO chain, the cleaner and simpler the business is. It's just easier for us to do business with that. We'll still have the other markets, the remote and rural areas, but the more we can drive through those consistent chains, the better. There are some risks, obviously, and you've mentioned the self-management side of things. There are pros and cons to that. Trusting the partners to do their job. They're skilled at it. They've been trained at it. We trust that they are going to deliver for us the proposition that they've presented, the service level agreements that make sense to both sides of the equation. We share a common philosophy of making sure the customers return to whole in the most effective way. There is an incentive for an MSO to deliver the best possible cost-effective return without cutting corners, because then we end up with an unhappy or an unsafe customer. We want the same return. So we share a lot of commonalities as far as our ultimate objectives. The private equity side of things could concern me a little bit, but I shouldn't really have to worry about that.
Why?
Because there's a profit motive. And obviously you think that, okay, more is better.
So that might be at your detriment.
Right. The stockholders are saying, give us more, give us more, give us more. How do you do that? Do you raise the price? That's one way, certainly. Or you increase efficiencies or reduce your margins. There's economies of scale related to the MSO model, which is the same as the way we look at it from an insurance standpoint. That's the good side. We hope that they will continue that sort of behavior, that proper business. So one of the beauties of the MSO model, from a perspective of mine, would be that they have an appreciation for good quality business. They have an appreciation for those things that are under the microscope. The private equity does provide an element of that more microscope because there are more people looking at the behaviors of the business. That also benefits the insurer because there are more people watching. There's a component of additional reinspection. The insurer can then send in our own staff to make sure things are going the way we agreed. There's the possibility of using someone like Farzam is here, Farzam Afshar from Verifax, to use sort of a third-party viewpoint that can kind of complete that triangle. So it's a multifaceted relationship, but when it comes down to economies of scale, I think it benefits everybody, every part of the relationship, to have a good, healthy, efficient, and compliant situation.
Okay. I could take a couple of quick questions if anybody wants to raise a question. No? Okay. Brock, final word for you. What's the landscape going to look like for you? Talk about leadership, leading company in the business. What does leadership mean for you, and what does lead mean for you now, and what do you think it's going to look like in a couple of years' time?
Leadership can mean a number of things. Leadership can mean leading by size. Leadership can mean leading by innovation. And I would say that, right now the large MSO group, and I'd probably extend it beyond the large 4 to the large 65, are all leaders in their own right within the North American industry. I think we also have leadership in the form of some of the franchise networks that have evolved, and as I commented on earlier, particularly in the Canadian market. So leadership can mean a number of things. The goal for our company is to continue to grow. I outlined that we have a minimum growth target of 6 to 10% in terms of units and sales, plus some same-store sales, plus multi-store growth. Realistically, that should translate into 15 to 25% growth per year. But that growth on its own, without continuous improvement in the operational excellence part of the business will not translate into leadership unto itself. It has to occur with continuous improvement and continuous striving for operational excellence.
Optimistic, hopeful, positive?
Oh, optimistic.
Great.
Not hopeful.
Good.
Optimistic.
Optimistic.
Yes.
I think these guys have done Matthew Ornstein proud. Please give them a round of applause.